Welcome to the Broken Pie Chart Podcast, episode 239. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today?
Good, Derek. It's good. Look, we're recording this on a Friday, and it was an interesting week in the market, so I'm excited to talk about it all today.
Well, I did, of course, reach out to Jay Powell once again. He apparently was busy, couldn't come on, and so it's left up to us.
What are you saying? You boot me off for Jay Powell? But you got to let us both host if he comes on.
Well, of course, he's never coming on. Certainly not this show, but
never say never.
We can speak for him. So you're saying there's a chance.
Right. Good one.
All right. So Powell talked, it was all going so well. They came out with the decision, not going to do anything. Rates did rise after that. Powell steps up to the microphone, and they should have unplugged it because the markets did not like the words that were coming out of his mouth, Jay.
Oh, I mean, get the cane, get the hook, and pull him off. I mean, apparently it was. I'm going to tell you, I listened to it, right? And yes, there's anybody surprised he had to have a hawkish tone? No, of course he has to stay hawkish. He has to keep trade up. They have not beat down the inflation monster yet, so he has to talk hawkish. But his actions should have spoke louder than words. The fact that they did not raise rates. And I don't know, and what was the market just reacted pretty poorly. And it's been, since that time, down, right? That day finished down, and Thursday was down, even a little downward bias closed at the low here on Friday. So, yeah, market didn't seem to like it. But again, I continue to think through, what did he say that was so surprising that caused the market to sell off? I missed it. I missed the bad news. I really did.
It really was about 12 reporters asking the same three questions in different ways. And I think at one point, I even messaged everybody, and I'm like, he's got to be like, are you serious? What do I have to? I already told you, we're not lowering. We don't have any plans to lower. We'll lower if we need to lower. And I get it. I guess if you're a reporter for XYZ outfit, you want to hear your question be repeated and his answer to your question. So you can go on air and say, I asked Chairman Powell the following question, and then they play the clip. But you know that. I mean, Leisman asks the same stuff that the guy from Bloomberg does, the guys. So, no, Jay, I agree. I don't think he said anything differently. Now, the market, though, when I say the market, I'm talking about the bond market. It seems like they actually believe the Fed now because rates rose, especially in the back end, Jay.
Yep. Yeah. And if you're watching and you're trying to keep track how to see that, you look at even some of the ETFs, right? And how they reacted. They didn't react right away, but on Thursday they did. TLT dropped significantly. That's a 20-year, right? The 20-year ETF. And when you look back to find it at this price, I mean, you're going back to 08, right? 03, where it is right now is definitely low. So, right, that means rates are higher, the bonds are lower, right? So the bond funds definitely reflected some of that. I was trying to go back to see, okay, when's the last time that TLT has really been below, 90, right? And if you go back and you look, it doesn't happen all that often, right? We got to go all the way back to, where am I here? March of 2011. It bounced off of it in 2010. It was some support in 08. So it's been a while, right? Since this kind of a pricing showed up in the longer end of the curve with ETFs like that, at least with, TLT, which is a very popular bond ETF, right? It's got long duration. It's got all the volatility in it, but it reacted poorly, I would say, come Thursday.
Poorly? I mean, let me put a little more color on this. Let's say in 2020, you bought a fresh off the rack 30-year U.S. Treasury bond. That bond today is trading probably around $48. And what that means, if you spend $1,000, your bond, your single bond is probably, it's worth, it's half of what it was. And when you think about how long it would take that investor to get back to $1,000. In theory, if rates don't go significantly down, it would take 27 more years. You're 3 years away from that. So there's been some damage in not only TLT, we see it in AGG, the US Aggregate Bond Index. And it's not, this is what happens when you had low rates and you have rates that go up, you have duration. So, but I think bond market is like, okay, higher for longer. What's really interesting though, Jay, is this. And there's two schools of thought. One is that rates on the long end are rising because, as I've said before, the 10-year US Treasury is really sort of a proxy of the nominal GDP growth, not adjusted for inflation, just with inflation, with everything. And if you look at a 10-year yield and you look at the past, decade or so of nominal growth, it's probably about the same. So you could say, no more recession. The bond market is now saying we're going to have growth. It's all cool. Everything's fine. But we got to go back to, Jay, the 10-3 inversion, the 10-year and the 3-month inversion. And that maxed out, the distance, meaning how much more the 3-year Treasury yield is greater than the 10-year Treasury yield. Normally, the 10-year should have a higher
right?
yield. The spread.
The reference spread, yeah. Yep.
Yeah. So normally, you want to get paid the more time you're loaning, let's say, the government your money. That has started to narrow. And the interesting point of this is, okay, Cam Harvey's the guy who came up with this. It was an academic paper. It's predicted 8 of the last 8 recessions. And it first inverted, I think it was October of last year. So the median time to recession is about 12 months, which would be about October 25th of this year. And I think January 25th of next year, 2024, will be the far end. But typically what you see is, and it's not close to uninverting, Jay, but you do see it uninvert before a recession. By the way, which of those two is going to happen? I'll let you know when they happen. Right, Jay?
Yeah, right. Yeah. I'll throw you a curveball, Derek. Looking at the UUP, which is the Invesco US dollar index, right? That's something that we always talk about when we're talking about, you might talk about it when we're talking about bonds and yields, right? That is, while it's not an all-time high, that is also pushing to a level that, yeah, it had a little bit of a pop there in, the middle of 2022, but this thing's been on a, it's also going higher, right? Meaning, so maybe we could talk a little bit about the dynamics there of kind of currency and like U.S. yields versus other yields. Is that something you're willing to touch on real quick?
I can touch on it. Yeah. It's the dollar, it's a relative game. And the idea is that if the perception is, or the actual rates are higher in one country versus another, and all things equal, which, from a risk standpoint, that country's currency should be stronger than the other one. That's why the yen is hitting multi-year lows against the US dollar. So, yeah, Jay, I think because our rates are rising and our rates are higher than other parts of the world, and the perception is higher for longer, yeah, that causes the dollar to go up, Jay. And we know that has ramifications for multinational companies.
Yes, that's what I was bringing it to. Then a rising dollar, and we talked about this last week, can have negative ramifications to the profit of U.S. companies that have business in other countries, right? We talked about why that works. So I just, thought I'd kind of connect the dots there as to rising rates and, potentially the reaction of the market, the equity markets, with the dollar in the middle having that reaction.
I want to get to we're going to play a little, I don't know if we call it a game, but is our option prices cheap or expensive? But before I go to that, I'll say, well, 2 things. One is, I've been on this for a while. If you look at a chart of the US dollar index and you look at a chart of the S&P, they've been negatively correlated pretty tightly. When the dollar made its high, the market's made a low. So I think your point is, if the dollar is going on a run here, what we've seen lately would say that's going to put equities under pressure. Now, back to the bond side is high yield. I want to talk a little bit about high yield. And the question really is, are you getting paid for, I think investors are getting paid for taking that risk now, Jay.
Yeah, right. So it was, I remember, we were talking about at the beginning of 2022, the end of 2021, saying, look, there's nowhere to go for yield. I guess you could go to the high yield market and get paid 6%. Well, that is now started to, and by the way, high yield, also known as junk bonds, typically considered the riskiest of the fixed income, one of the riskiest from the fixed income asset class. We had always said, look, it just doesn't feel like you're getting paid for that risk, but that's the only place you can go to earn five. I think at one point we're only getting 5% on some of the
No, that's
high
right.
yield
That's right.
ETFs are trading. So today, now you're starting to talk about, when you look at, maybe like a SJ&K, which is an ETF we use, or SRLN, right? Those ETFs, not a recommendation, but they are in some of our portfolios. Now you're pressing what, 8%? 8 plus.
Higher.
Yeah.
8.3 to 8.9. Loans, which of course are variable, but Jay, to your point, yeah, they're pushing mid eights, high eights.
So, it almost feels like at this point now, like, all right, I know high yield doesn't have the same volatility as stocks, right? But if you're thinking bonds, it is, on the riskier side of things when it comes to bonds. Yeah, now you're getting paid a little bit, right? To take on some of that risk. I think you're getting paid, and I think it's nice to see that, that rate has been increasing along with the increase in Fed funds rate. Where I haven't really seen it as much as, investment grade debt, right? Like that, there's some investment grade debt that's out there that is, still less than the treasury. Like, I'm looking at the yield on LQD, it's under 5, right? So, it's nice to at least see some yield show up in sirloin and the S junks and those types of, we say S junk, SJ&K is the ticker on that one that I'm talking about. Yeah, it's nice to see that you're getting paid. I think you're getting paid for it now.
I agree. And, the AGG, I was looking at this the other day. September 14th is when I pulled this, 4.44%. It's probably higher now because AGG has gone down with higher rates. But it's like, would you rather buy a treasury or would you rather hold AGG? Given the choice, not a recommendation, I'm just saying these are things you have to consider. It's not as easy as it once was to say, oh, I can hold a risk-free treasury, I can hold AGG, which has a little duration in the portfolio. By the way, Jay, speaking of duration, that's the other thing. So fixed income is it's a more complicated asset class than people realize, because you think about bonds and you think, well, it's just an old bond, stodgy old bond, but there's a lot of math, much like options have math, and we'll talk about options in a second. But high yield, fixed income, whether it's treasuries, investment grade, they have duration, and duration is just a measure of what is the sensitivity to a change in interest rates. Jay, I pulled some the other day, and TLT, which, as you mentioned, is 20-year plus debt. It's U.S. Treasuries. Its duration was pushing 17, and the back of the envelope would say, if you went up or down 1 full percentage point today, you'd make or lose, 17%, right? AGG was a little over 6. IEF, which is a 7 to 10 year Treasury ETF, was 7.75. But then you go to some of the, and we use as you said, depending upon the investors and the risk tolerance and their strategy, we use some of the State Street products, and we talk to them quite often. But SJ&K was, roughly 2.3 duration, meaning for every 1 point up or down, make or lose about 2.3. HYBL, which is sort of a combination of loans and actively managed, it's about 2.4. But SRLN, which is senior loans, which are floating, they have, I don't want to say no duration, but I think it was 0.3 or somewhere around there. So different types of risk, credit risk. But as we think about what happens when rates go higher, it just, I guess it's not an easy choice anymore, Jay, because you are getting paid more. You have more credit risk. Let's just be clear about that. You have similar risk to, let's say, the S&P, but the yields are much higher now.
Yeah, I mean, again, no recommendation, but sometimes, I mean, you use it. I mean, I think the way we talk about the way that we use it, right? There's a specific purpose for that yield, right? And we know, hey, we're willing to take in certain circumstances, certain strategies, that risk, um, and let it swap out equity risk, right? When the markets are lower, but it's one of those things that use it as for us, we use it, deliberately with a specific purpose versus trying to make a call on what interest rates are going to do and have a duration play. By the way, we have kicked that around, right, about adding duration to a portfolio. We've talked about it on this podcast, how managers who added duration as treasuries got to 3% and 4% because they thought, well, when it comes down, I've got the upside capture associated with that. Of course, that is not been the right call so far, the way treasuries are trading. But that's not something that we typically do, right? We said there's a specific purpose, and that yield is put to work in conjunction with option strategies. So, yeah, I think you get paid now for it, and for us, it's use it for whatever the purpose is going to be. Difficult, like you said, a lot of moving parts when it comes to that. I will add in there are some times where just the easy answer for people that just want a safer piece, treasuries or short-term treasuries still have an attractive lean to them based off of the return that they have and the lower duration. So, use fixed income as you need.
Yeah, I mean, 5.5% on the short end and little or no interest rate risk. I mean, your duration is minuscule. Just a little disclaimer too on high yield. People should understand. Although we say you're getting paid for risk, and Jay, I think you made the point. High yield, when there are major issues in the markets, typically what you see is spreads widen. That means high yield bonds decline, making their yield go up, and the difference between its yield and treasury starts to widen. And so, there's risk in there, and I'm done with my disclaimers, Jay. But I just wanted to make sure we're not telling people to go out and necessarily buy high yield. All right, Jay, I think we're good with that. Can we transition?
Good with that.
I want to give you a quiz. All right.
Oh, right.
Here, well, let me test your options knowledge. I'm laughing as I'm saying that.
I love it. Give it to me.
Yeah.
Wait, is it multiple choice? Okay.
Well, no, I mean, and you can test me after too. So
okay.
I'm going to give you an option with a half hour left today. It's a call. Doesn't matter really, but it's a call. Was priced at $1.30. There's an option expiring Monday. And by the way, this was when the S&P was at 43.44 and the strike was 43.50. Totally randomly why I did it. I just, the market wasn't exactly at the money. I was trying to get close to the money. So there's one Monday that expires Monday afternoon at 11.90. So we have $1.30, 11.90. One on October, that's 31 days away, $74.45. One next September of 24, $390.40. And by the way, just for kicks and grins, a December of 28 option, which is 1,910 days away, that will cost you $1,111. Now, Jay, which is the most expensive option?
Oh, okay. So, it's something I talk about all the time. Options don't price linearly, meaning, a one-day option is half as much as a two-day option, right? That's not the way options work. Options price more exponentially, like a parabola. So I would say the most expensive option is the one with the shortest amount of time on a time basis, the one that's got a half hour to go. So if you added up all the half hours for the year, I bet it would exceed the 1 year option in cost. So I'm going to say the half hour is the most expensive.
Yeah, that would be correct, Jay. So I don't have a bell, but that is correct. And the way I did, by the way, this is literally back of the napkin stuff I did. But there's 6.5 hours in a New York Stock Exchange session, which is 390 minutes. and a half hour into 390 is about, little 7.7% of the day. So on let's say a per day basis of my math there, that I'm probably making some errors, it's about $16.90 per day, because you're literally getting that option for a half hour. Okay, let's set that off aside. But if you compare, let's say, the 1 month on a per day basis, $74.45, 31 days to expiration, it's $2.40. The December of 28, which was $1,111, is 58 cents per day. So yeah, Jay, I mean, it's on a per day basis. The lower time to expiry is the most expensive.
And this is why products like annuities work, where you can hold options, or even just any structured product. We have some strategies that kind of mimic that, where we're pairing options with fixed income. This is why they work, because that time decay that you have, the longer you go out, the easier it is to pay off the cost of the call. Unlike options that are not linear, bond payments are linear, right? When you buy a bond, you know what your coupon is going to be for the next 5 years, right? If you were to pair up that December of 2028 with a, let's just round to a 5-year bond, you know what you're going to get. It pays you every 6 months. Here's your coupon. That is a very linear data point. Now, you might have some price fluctuation based off of the changes of interest rates, but as you get to the end and as you get to maturity, that is paying you, you're getting paid. It's a linear payment. Options are not linear, which means the farther you can go out, the better those products can work for you. It's one of the reasons why we do develop products like this. And I haven't done the math on this, Derek, but if I bought a 5-year bond, how much would I have to buy in 5-year bonds to fully pay for that 5-year option, that December option? You said was what, like over $1,000? So I'd need to make $1,000 in coupon payments for that. Actually, if it's, I'm assuming you used SPX, correct? So
Correct.
that'd be $100,000. So how much would I have to invest to get paid $100,000 over those 5 years, right? So let's just round to 20,000 a year at 5%. Yeah, actually, I think that's a pretty good build, Derek. People should call you about that build. You want to kind of,
Mm-hmm.
have upside market exposure and have it paid for by the full faith and credit of the U.S. government in the form of a treasury. That might be an interesting trade.
Yeah, and basically what you're saying is, I mean, it's 1 times 100 times the price, which is 111,100, and yeah, I mean, it's sort of like you have that if you have some treasuries in there. Yeah, that is kind of an interesting one. That's what's fascinating though, Jay, about the longer term options is the implied volatility, and 26.9% is the implied volatility for the December of 28. You compare that to 1 month, 14.72. Mondays is only 8.35%. And so naturally, you might look at that and say, well, wait a second, you just said the really short ones are the most expensive per day. No, that's correct. But think about in the next 5.5 years, well, not 5.5, but 5+ years, it's saying basically that there's going to be a 54% or 50% one standard deviation expectation, sort of cone around the market. That sort of makes sense. Think about a 5-year. If the long-term average is 10% annual, average, simple average for the markets. I mean, that kind of seems like back of the napkin good, right?
Yeah, I mean it's a little high in my opinion, only because I always think about the long term average of the VIX, and it's not 26, 27, right? It's more in the low 20s, but I do think it. And I don't think, by the way, that's a market call. I don't think it's the market saying, "Oh, we're going to have a recession in 2 years," right? Why that's built into that price. I think that is along the lines of what you just said, based on the general appreciation and averages of the market. Yeah, that probably makes sense, because that implied volatility is derived by the cost of that option, of that long call. So I think kind of the whole cost to carry thing in there is pushing the price higher. So yeah, no, I don't think. Obviously, it makes sense. It's what it's trading out of the market. If you actually wanted to trade that option, I'm just curious on the how wide that bid-ask spread is. Yeah. So while you priced it there, well, I can't tell the market. The data's not streaming.
Well, and by the way, just for the audience, the 4350 strike does not exist for December of 28. I had to do an interpolation method between the 4300 and the 4400 to estimate those prices, because I use the 4350 for every. So if you're looking, Jay, and you're like, wait, where is that? No. I did the interpolation method.
I'm looking for that price, but yeah, I got you.
Yeah. But it's all black. I mean, it's all math,
By the way, at 5%, if we were earning 5%, which we're earning a little more in the 5-year, just $440,000. So if you show up with $440,000, buy the treasury, the 5-year, and then also have another $111,000. So a total of, let's say, $560,000. You could build yourself a nice little upside exposure with only, without taking a lot of market risk, because all your long calls completely get paid back by the yield off that treasury. It's an interesting build, Derek. It'd be interesting if somebody actually ran a strategy like that. I wonder what they would call it.
Well, they'd probably email me to find out more. That's what they do. Derek.Moore at Derek.Moore at ZEGAFinancial.com, DEREK.MOORE at Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial's up to you to spell correctly.com. Yeah, Jay, that's called Z Big Treasury.
Z-Big Treasury. And it looks like that call's got like a 50-60 delta, right? So that means, you're going to participate in a decent amount of the upside move in the market while having the call backstopped by the coupons that you're getting paid. Interesting. Yeah, I love it. Maybe we'll sell that to somebody somewhere.
Yeah, the downside is it's really opportunity cost, because if the market goes down or goes nowhere, you pay for the cost or partially pay for most of the cost of the option. But if the market goes nowhere and you don't have any appreciation, right? I mean, you sort of don't earn anything over that time too. So there's different it's just a different payoff structure, but it's interesting. By the way, I don't know if you ever saw Warren Buffett and Charlie Munger talking about options. A lot of people think that they would never use options, and that's not the case. In fact, Warren Buffett has sold very, very long-term puts. I'm talking, this is where, like, if you ever watch The Big Short, you have to have the ISDA agreement, and these are not ones that are traded on the exchange. And I think he actually did he sold 10-year puts, and I have to find it, but I think he looked at it as almost an insurance company would look at it. He took in money, so he sells a put, which doesn't give you rights, but you're obligated to buy the asset below a current, a certain price. So he takes that premium in, and it's probably, as we just said, the gross amount of dollars is higher, although the cost per day is lower on longer term options. But he takes that in and he invests it, and he probably looks at it as just getting paid to have an option on something. But they asked Charlie Munger, and Charlie Munger is like, Black Scholes is useless. Black Scholes is what, a lot of our industry and it's the foremost thing of pricing options. And his point was, for longer term options, who even knows whether the assumption are right on interest rates, on the volatility, on all those sorts of things. But anyway, it made me remember that they've actually used those at Berkshire.
Oh, absolutely. Yeah. I mean, one of Warren Buffett's favorite strategies is cover calls, right? And using short puts, as you said, to leg into positions. I mean, that's, maybe it's not something he talks about all that often in the shareholder meeting, but we know for sure it's something that he talks about. So yeah, I think it's great. I think, the Charlie's point is very spot on, that you have to have a projection on where volatility will be between now and the expiration of your option. I think interest rates can impact it, right? There's factors that you just don't know, but it is still, the Black Scholes model says, look, based on where the market currently thinks things are going, here's a price on that option. You may think it's expensive or cheap, but this is the way the market is looking at right now. And that's something that, we talk about fairly regularly if options look expensive or cheap. We talked about last week, I think we talked about how options were on the cheaper side, didn't we? A little bit, right? So this week, not as cheap, right? Not as cheap with the way that the market has moved here the last 3 days, but still not. I mean, not even close to out. To breaking back up to a period of fear. Where did the VIX close today? 17 handle. Yeah, it's off the 12 that we talked about. I think we had a 12 handle last week. We got a 17. Little bit of fear creeping into the market, meaning people are willing to pay a little more for speculation, which could be protection, right? Or it could be on the rebound either way. But yeah, little more expensive than less.
Yeah, no, and we've hinted that we do have a quantitative strategy or some methods that we use. Let's just leave it there. And yeah, I mean, I haven't done my calculations yet for the day, but volatility was getting very compressed. I think you noticed that too. And what that means is if you look at something like the VIX or you look at something like VVIX, which is the VIX of the VIX, it's the standard deviation of the change of those starts to get really, really tight. And when that happens, often it's the volatility market giving us a signal.
Yeah, that's true, right? One of the triggers that we used for that strategy was saying, look, this when things compress like this, it's like a coiled spring. Maybe you've got some wider moves ahead in the near future, right? And that was so far. It's done a good job of getting us prepared for that. Wednesday, Thursday, Friday of this week.
Back to what Charlie Munger was saying on the Black Scholes model, and of course, there's Black Scholes, there's Bergstrom, Stenson. There's different models for sort of pricing
There's
these
the
instruments.
Derek and Jay model, right? That's
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 right.
the good one. Derek J model.
Do we? Yeah, we have one of those, right? Sure,
We do. We do.
we actually do. But back to his point, and I'm let's just use that December of 28. So think about that. That's a full 5 years away. 5 years and October, November, December, and 3 months away. And we just talked about how they have that volatility of about 27%. I think it was in the Big Short. It was a Brownville Capital, and they were the ones who bought. They had Brad Pitt helping them to trade. They were trying to get the ISDA agreement. And they were getting laughed out of the lobby at J.P. Morgan Chase. But in I think it was either in Jack Schwager's book, Hedge Fund Wizards, or another article. I'd have to look it up, where they talked about how they thought longer term options were mispriced. And I wonder too, although when we say the bell curve, it's not exactly symmetrical. Like sometimes
No.
the market prices a higher probability of markets going lower than higher. But when you go out, the further you go out, and with volatilities like that, like you're almost getting a discount on one way or the other because the probability is there that markets can be, and I'm holding my hands up here and here. You know what I'm saying, Jay?
Yeah, yes, and gosh, when I think about, I mean, just think about this, right? How the market can only go down so far, right? So when you go out in longer terms, that bell curve gets kind of a little squashed on the bottom. Like if it was a perfect bell curve and you go out that far, and there's look, there's a chance the market doubles, right, over 5 years. Of course, right? I mean, that has happened. Just the 19, 20, 21 period, the market doubled, right? But the that same parabola that would say, okay, the chances of that are, I don't know, 5%, 8%, can't tell you that won't say that there's a 5 to 8% that the market is going to zero, right? So the downside, typically when you go out longer in time on the options probabilities, will compress to the downside, right? It'll start to look almost like it's like somebody dropped the parabola on the floor, and that leg of it, that curve of it gets squashed a little bit. So yeah, you're right. The longer term options, the parabola does not continue because you can't go below the zero line, I guess, unless you're oil during April of 2020. But I'm kidding about that, right? But the deal here is options definitely become more and more skewed the farther and farther out you go in time, which is why the example I gave you, you need to have kind of like a structured use for using an option of all that time, right? You should have a purpose. It's not a speculative option that we're talking about here. Although, Derek, I do think you made a speculative bet at one point, and you said, "I'm buying as soon as the longer dated SPY calls come out. I'm just buying one, whatever the longest dated strike is." You just bought it, and you've done that almost every year, a little bit, thrown it out there, and I think it's probably paid off most years for you. It's a fun exercise you do.
No, I spread it off. And it's really lazy. It's totally lazy, but it's one of those things. It's, as you call in your book, buy and hedge, instead of buy and hold, buy and hedge. Great book to pick up on Amazon. Pair it with Broken Pie Chart, also on Amazon, my book. But Jay, you made the point of, inner guru, and that's one of those inner guru trades. It's, maybe it pays off, maybe it doesn't, but it's sort of an asymmetrical bet where it's a little bit of money, but the payoff is, and so on a tiny amount of money, it's just something to have out there. But I like to spread it off. It is lazy, and when I say lazy, it's when you have spreads on things that are really far out. If you get a move like tomorrow that you want, it won't sort of pay you out the whole bit because you have to wait for the time value and things like that.
Yeah, you won't reflect that move, right? So instead of, market's up $1, oh, congratulations, that 3-year call spread is only up 10 cents, but the market's up $1. Yeah, it's a lazy option. It's got to get all the way there for it to reflect that sensitivity to the daily change of the market.
Last thing on this that's kind of interesting, and maybe this is Munger's point that he was making about the Black Scholes. Think about if you remember 2017, volatility, I mean, the actual spot VIX was, I think it almost got below 10, might have gotten 10 intraday. And that is, for anyone who doesn't know what that means, it's super, super low. But imagine that you had sold an option and it had a volatility expectation of 17, and maybe it thought rates were going to go to 3%. Well, rates were 0 and volatility was 10. So in that case, it mispriced for what actually happened. And you can flip that around. Like, let's say you thought it was pricing in rates were going to be 0 forever, and all of a sudden rates go up to 5%. They're not, the expectation on the long side of the curve is not 5% quite yet, it priced in. But you would have seen the cost to carry go up if you were owning a call. Just that cost to carry, the increase in interest rates would have risen the price of the call. So, but that's a professional's game. You're trying to figure out mispriced Black Scholes modeling. Good luck to the, I wouldn't necessarily play that game.
Yeah. Well, look, being long row has not been a strategy a lot of folks have talked about. Although, Derek, I do think you and I spent a little time on trying to, look for option strategies that just, can get you bullish or bearish interest rates through the cost of carry trade in the S&P. So I think it was a fun exercise for us. I'm not sure if we're going to convert it to a real tactic at any point soon, but it's back pocket for us. It's kind of on top of what you're doing with something else, right? So interesting stuff.
Before I get to recommendations, you mentioned oil, and I think I want to bring that up. Not necessarily the price of oil, but the fact that, well, we can talk about oil today. It's broken 90. Is it a lot of people saying it's going to 100? But I want to talk about just the difference in, you mentioned oil futures went negative. They did. And the difference between futures and, let's say, listed exchange traded options is the buyer of a call can only lose what they pay for that call. But if you buy an oil futures contract, that actually could go negative. And it did go negative. And the reason why that is, it's a physical commodity, and there was so much supply of oil, there was absolutely nowhere to put it. So I think Cushing, Oklahoma, which is a big station that takes in oil, all the oil tankers go in there. They're like, no, nobody wants it. Nobody wants it. You literally could have gotten paid to buy a barrel of oil. And some people said, well, why couldn't I buy a barrel of oil? A Bloomberg reporter, Tracy Alloway, this is actually not during 2020. This is prior. She tried to actually buy a barrel of oil, and they're like, you cannot, you have to store those. Like, they're toxic. You can't take that to your house, you know?
You can't just throw it in the living room.
Yeah, no, she actually
Throw
did
a
a whole story
tablecloth
about it.
over it.
Yeah, it was on oil. But that's the difference. Futures, they actually can go, you can lose more than you put into a future. And it's just different. But no, that happened.
Well, yeah, and that definitely happened during 2020. I almost felt like nobody wanted to take the delivery of it, and people were just saying, "Please get me out of this contract. I just need to sell this contract, or I'm going to get I'm going to have to take delivery of the oil that I was trading the futures on." And it was a 1 day. Was it a 1 day? I think it was a 1 day event, right, where everybody just it was a fire sale on that particular future. And yeah, it went negative. And you always think about when we say the max risk you take when you sell a put is the price of the underlying, right? Hey, if the stock goes to zero and you're short a put, that's the most you can take. Not in the futures market. People that had short puts on oil ended up losing more than the value of the barrel of oil that they thought that they'd have the risk on, because it went negative. I think it went to like negative $30, didn't it? A barrel, or negative $25 that day.
It could have touched there. And
Yeah.
by the way, I had somebody who's never traded futures before text me and say, "Hey, how do I buy a barrel of oil? Because it can't go below zero." I said, "It can go below zero, and it probably will today." I said, I have no interest in trading it, but I actually said, I could probably short this. And let me just put some color on this too. When you own a physical commodity of futures, normally uh, you have to, when you own it, you take delivery. That means if you own oil and you own this futures contract and you get to expiration, whatever the value of the contract, you're taking delivery of barrels of oil. And if you actually take delivery of something, not only do you have to take delivery, but you have to store it somewhere. You have to arrange where you're going to store it. There are storage costs. Then you got to figure out, like, how do we actually sell this stuff? Like, you're not a oil merchant, right? And I can I can tell you this. I think it was, I forget what year this was. This is before the internet and everything. And I had it might have been sugar, and there was a mistake. Normally, the brokerage firm will tell you, hey, you have to roll or cover before this date. And for whatever reason, I rolled a cover, but there was a mistake. And they called my house and said, we're you taking delivery of this sugar. Basically, think about a rail car filled with bags of sugar. And yeah, that was it. Anyway, it got worked out.
You worked it out. You're still not working through that sugar. Lots of cakes.
No, I remember, and they. So it's a little, that's our public service announcement.
Sunny in Philadelphia episode where they wanted to sell gas, and they bought gas. They were trying to sell it out of a barrel on the side of the street. But if you guys know, if you're familiar with Charlie, Mac, and Dennis, it's a funny episode. But there you go. Maybe that's my transition for you, Derek.
Yeah. So what do we got as far as? Well, I'll start with recommendations this week. I mentioned my wife told me, "Hey, why don't you watch the Johnny Manziel documentary on Netflix?" I think it's called. It's not called that. It's like a series, but this is one in the series. It was great. I thought it was great, and it was crazy. There was a story where he decided, you know what, they're selling my jersey. It's like tons and tons of money the school's bringing in. I'm not really getting paid, and he used to have to sign, a couple hundred footballs for the boosters. So he gets hooked up with this guy. Him and his buddy would fly to Miami. They'd go into the hotel room, sign like, I don't know, 1,000 footballs, 500 footballs, whatever it is. They would take a picture and text it to the guy, and the guy would text them a code to the safe. And they'd be like, 30, 50, 100 grand in there, whatever it is. So it was just, it's crazy. I really enjoyed it, Jay. And I forget how crazy that time was. I mean, when he beat Alabama in that game, people were going nuts.
Yeah. Well, as an Alabama fan, I definitely remember that.
Yeah. So, all right, Jay, what do you got?
Okay, so two recommendations. The first one is, I think it's one I've mentioned before, but a new season is out. It's on Hulu, called Only Murders in the Building, with Steve Martin and Martin Short and Selena Gomez. Entertaining, quick, easy watches, half hour, 25-minute episodes. I'm still getting through that. So that one is out there. I'm watching that. And then a little deeper one is on Apple TV, called Foundation. It's a sci-fi show, kind of loosely based on the novels of Isaac Asimov. So that one is definitely a little weirder to watch if you want something that's going to kind of really keep your interest. It's not one of the ones you could read your phone and watch TV at the same time. Like, you're going to have to watch that one and pay attention. There's definitely some very cool concepts in that show, Foundation.
I feel like Asimov, I've read, he's got books with short stories. I feel like it's been a long time since I read one of those, but it was science fiction. I remember those.
Yeah, I mean, I didn't realize, right, he was born in 1920. I think he died in like the 90s, right? The late 90s. So early 90s. Now that I've just Googled it while I'm standing here. So, yep, April 6th, 1992. But lots of definitely a very famous sci-fi writer. Yep.
All right. I had one other from a listener, Jay. Michael, one of our longtime and loyal listeners. He said we should check out Plutonic on Apple TV. I think that's Seth Rogen is stars in that.
Plutonic. Yes, I think so. It looks funny. I have not seen it. I thought you were going to say Barbie again, Derek.
No.
Double recommendation on that one.
No.
You keep getting that wrong. Sorry.
No. I'm not seeing Barbie. Never see that. Probably not.
Now I've made it that you can't see it, right? So when I watch it, I will let you know how it is. I'll bring it back to the show.
Please,
I thought you had the pink sweater and the pants. You did the whole pink thing at the theater. No,
I did not. I was not at that theater. I was not there. All right. Last thing, an anti-recommendation. I think it's. Can we write off the New York Giants football season?
Oh my gosh! How frustrating is it to watch those guys? It's tough. It's tough to watch them, right? But look, nice comeback against the Cardinals. But they should have never even had to have a comeback like that in the first place. And listen, I think Dallas embarrassed them clearly first week, and then San Francisco just this Thursday beat them again. And look, maybe they just were playing, the two of the 3 or 4 best NFC teams, but you're going to compete. You got to compete, and they're not competing. I'm definitely disappointed in my Giants so far. So no, it's an anti-recommendation.
Yeah. Well, of course, I live in Arizona. Since '96, I do root for the Cardinals. I've had season tickets. I'm not going to any of the games this year. Somebody else is taking them. But yeah, between the Cardinals, the Giants, and the Jets, I think I'm open for business. I got to pick a new team. So maybe that's what I'll do this week, Jay.
Just don't watch the Cowgirls. You can't. I mean, the Cowboys. Sorry, just can't watch those guys. Yeah,
I agree. All right, Jay, let's call it there, and we'll be back next week with some biting commentary on the New York Giants and other things market related. See you, Jay.
Thanks, Eric. Bye-bye.